Okay, let's take a deep dive into what stocks are doing right now. Let's talk more about markets and the trade war and the impact of everything happening. Joining us from Minneapolis is Bryce Doty. He is SVP and Portfolio Manager at CIT Investment Associates. Bryce, thanks for coming on.
Thank you for having me.
Let's talk about all the volatility of the last few weeks in stocks. And then we were just discussing at the top of the show this report that the Trump administration is considering some kind of new changes to juice the economy. Obviously, he's seeing the market and does not like it. Can't tout that as a win right now. Included in this report is maybe a new payroll tax cut. What do you make of that?
Well, it seems like the market was relying on a Powell put before to kind of save it, have the Fed come to the rescue. Now maybe they're looking for a Trump put. So anytime the stock market gets too volatile, they're looking to the president to, either say something positive on trade or do something else like what you just mentioned. And, it's probably a short-lived boost. But this pattern that we've seen, it's kind of a sawtooth pattern in the stock market. I think that's going to continue for some time. So it's difficult to play it, but if you can be brave on the days when the market's weak and not get swept up to any optimism that seems to be propelling it higher and maybe pull back a little bit, that seems to be the way to play this volatility.
Hey, Bryce, let's talk about this inverted yield curve situation, because I think what got missed last week when the yield curve inverted for 20 minutes is the fact that the yield curve needs to be inverted for a prolonged period of time in order for, the recession bells to really ring in a meaningful way. Do you agree with that? And how come people aren't talking about that?
I do agree, because every inversion happens very uniquely for different reasons, and none of them have been created by a trade war. So it's difficult to really think about exactly how this is going to play out. But as a bond investor, remembering the crisis all too clearly, when I saw that inversion between 2 and 10 years hit the same level it did in 2007, so that had a chilling effect on me. And as a veteran investor, if I have that kind of reaction, I knew that the downturn in stocks had to partially be due to an emotional knee-jerk reaction. So we're only 4 basis points away from that inversion happening again. And so I think there's a lot of emotions going on around that point that may have nothing to do with the logic of, hey, is this really going to cause a recession, or is our 10-year Treasury really just coming down because German 10-year yields are so negative? So by comparison, we're being pulled into that. And there's actually a really big positive that's happening from that no one's actually talking about, and that's the refinance boom that we could see for homeowners. Anyone who's taken out a mortgage in the last 2 years should be looking to refinance that mortgage into a lower rate. They should be able to shave off anywhere from half to a full point on their mortgage, and that's a huge positive for Americans. But I do get the emotional impact of seeing that curve invert just the way it did right before the big recession. So there's that fear is real, and so investors kind of need to be aware of what the curve's doing just from that standpoint alone.
Can we talk about, though, I guess, the impact that lower interest rates have on companies? You kind of mentioned what it means for homeowners, but just quickly, is there any evidence that lower rates are bad for companies?
I'm worried about how many triple B rated companies there are right now. It seems like companies are just borrowing because they can, and the money is so cheap that they're increasing the amount of debt that they have without any negative repercussions. The rating agencies and analysts and whatnot, they look at that debt and they're like, well, it's cheap debt, so it's not really going to hurt earnings and this and that. But I don't know. It just seems like it's not going to end well if people keep piling on all that debt. So on one hand, sure, lower rates are great. If everyone just kept their debt levels the same and brought all their cost of that debt down, that's fantastic for the economy and everything. But so many companies are starting to, load up the truck with debt, and that's the only downside that I see from the lower rates.
Well, that makes a lot of sense, and the knee-jerk emotional reaction in stocks is right. We will hope that ends soon. Bryce Doty, thanks so much for joining us.
Thank you.